Hi everyone, welcome to the Keeping Your Business Together in a Crisis live stream webinar series. This is part 14, What is Your Business Worth? It's a COVID-19 business valuation. We are recording this session at 10 a.m. on Wednesday, June 24th. And this series is produced by the Boulder Small Business Development Center to support businesses in Boulder County as well as the rest of the state through our TechSource program. We're one of 15 SBDCs in Colorado, so if you are dialing in from Vail as an example or Durango, you can go to coloradosbdc.org and find the SBDC that's closest to you, and we all can help you with consulting at no cost, workshops and trainings, and connections to resources. Our particular center is hosted by the City of Boulder, and we're part of a wonderful group of local, state, and national strategic partners that can help you during these challenging times. Please note we have everyone on mute, and we'll ask questions at the end of the session. So my co-moderator, Jamie Brandis, is going to take over at the end. And so you can go ahead and put your questions in the chat box in the GoToWebinar control panel, and Jamie will filter those to Suzanne and Don. And we are recording this session. You'll be able to receive a link tomorrow via email, but you can also always go to bouldersbdc.com, and on the homepage you can see all of the webinars that we've recorded so far. Feel free to listen to those and at your leisure. And at this time, I'm so grateful and excited to introduce Suzanne DeLucia and Don Hobbs. They are from Front Range Business Inc., and they have been helping businesses for years. They have been doing presentations for the SBDC, not just ours, but other centers as well. And we're just so grateful to have them on board today to share their knowledge. So Suzanne and Don, take it away.
Great.
Well, thank you, Susie and Jamie. Don and I are thrilled to be here. When all of this started, we were as perplexed as anyone on how do you value businesses, what's going to happen. And our team has spent a huge amount of time pondering this, listening to webinars, and we've come up with some thoughts and ideas we want to share. And please note it's only an educated guess. Don, do you have anything you'd like to add to that, or?
Well, I was just going to say, you said, you know, we've sort of been following this. It started with a kind of February, scratching our heads and wondering what in the world. We're kind of reading about things. And then March, it really hit and decisions were made that changed the way people operated businesses. And then April, I think, was total confusion. By May, we saw maybe a little bit of sorting out of how things could be solved, what it was going to take to get there. There was visibility. Now we're into June. We're trying to follow that. I don't think the numbers are necessarily showing that we have it under control yet, but we still know the methodology to do that, and we see it impacting different businesses differently. But I think there is some sense that we can start to project what the future might look like, as well as take a look at what we have seen happen so far, which is what today will probably be.
Great, thank you. I think that's a really great summary. So the focus of this workshop, there's going to be 4 sections. First, starting with how did we value businesses before COVID? And some of you may have been to our workshop, so it might be a little bit of a repeat. We're going to run through that pretty quickly. But that was the foundation for then deciding how to value businesses since COVID has happened. A lot of people are wanting to know, is there anybody out there that's interested and willing to buy a business? And then thoughts on how to come to a meeting of the minds with the parties. So
and by the
let's start.
way, Suzanne, so
yeah.
I'm just going to jump ahead on the answer to one of those questions. Are buyers out there? The answer is yes, but. And what we'll talk about is the but.
Okay, great. Thank you. Okay, So what is a business worth? It's not about what a company is worth in the current owner's hands, but what it will be like in the buyer's hands. Which of the business assets and intangibles can you transfer to a buyer? So there is a formula that's widely accepted. It's called the earnings multiple method. It's the earnings of a business times some multiple, which is a risk quantifier, is equal to the value of the business for a buyer. So you've probably heard of these two different earnings levels. EBITDA, I'm going to just define that on the next sheet. That is what professionally managed larger businesses use as their earnings level, and SDE, seller's discretionary earnings. A lot of small, closely held businesses sell via SDE. If you go on BizBuySell, it's what you will see most likely. So EBITDA, as a refresher, it's the earnings, the bottom line of the profit and loss or tax return on a business. Before interest, you get to write off the interest just like you do on your home mortgage. And the reason it's added back, a buyer will have a totally different interest structure. They may have no interest if they pay cash for the business, or they may take out a loan and will have certainly different interest than the seller has. So that's available in the pot of money. Some business legal entities like C corporations write off taxes on the net profit. That's a line item in the P&L or tax return. It's not after, you can't double dip. And there are two non-cash expenses that you see on tax returns. Depreciation, which is the write-off of tangible assets. The IRS allows a business owner to write off a certain amount each year based upon a formula. And that is nobody's ever written a check for depreciation, so the buyer has it available to them. And amortization, depreciation of an intangible. If you have patents or you're a franchise, you get to write off a certain amount each year. And when you buy a business, you get to write off the goodwill, the non-compete, so that gets added back. So this is the standard in earnings calculation on larger businesses. And smaller businesses use something called seller's discretionary earnings. The profit and loss statements, the business they look different. They tend to be run more personally. So you take the EBITDA, one working owner's salary, discretionary expenses that we all love to write off, car, phone, travel, entertainment, and also things like retirement accounts, life insurance, key person insurance. Those can be added back. We normalize expenses because a lot of small businesses tend to run the business for their personal use. But let's just say somebody owns the building that they're in. They may or may not be paying fair rent on that. We adjust the business profit and loss statement to put in the rent that the buyer will be having. And then one-time expenses. A business moves, it remodels, there's a one-time legal issue. All of these equal SDE, the amount of money one working owner can make out of a business. We run into a lot of businesses that it might be a couple running it. Well, they're going to have to come in and hire somebody to replace one of the partners in the business. So small businesses tend to be run a lot more loosely in their books, and so that's why we do this exercise. Then we have that multiple that you multiply it by. It's the risk quantifier. We always ask two questions. What's the likelihood of future income on this business? In our lifetimes, we've seen the rise and the fall of the video store. We don't have too many people wanting to buy video stores these days. The likelihood of future income is pretty low. There's still a few. There's still a Blockbuster in Bend, Oregon. And then it's the replicability of income. How much of this business is based upon the owner and their personal relationships? And can the income stream be transferred to a buyer? Don, gonna let you do a really quick run through on these multiple influencers.
Yeah, absolutely. So, all businesses are going to have a different level of risk, but in addition to the risk, which hopefully you can zero in on, there are other things that different businesses have as their attributes. And without necessarily going through, I'll pick a few on this. Sales profile and concentration, for example. That's a question. If you're selling all of your services to one client, all the eggs in one basket, so to speak, there's always the risk that if that client goes away, there's nothing left. So looking at a highly distributed sales profile makes a business more attractive and therefore less risky than one where it's all concentrated on a single. Recurring revenue, jumping down to the fifth one. There's an example. If every time you make a sale, you need to have a salesperson out in the field making one sale, then it's a function of how you can grind that out. But if you're bringing in customers who become recurring base and they buy from you over and over, and there's some stickiness to that recurring revenue, then again, less risk of seeing your revenue drop off. Looking at some other things operationally, management staff and labor base. Businesses that have good, stable management teams or labor teams that'll be able to carry on are less risky than those where there's going to be a wholesale turnover. I just sold a restaurant last year. 4 family members were going to leave the restaurant at the time of the sale. Well, that's going to significantly change the ability of the new owner coming in. And so that has to be addressed as part of the pricing, really, in terms of the multiple. And other things, that you just take a look at is a building is a company that's doing $3 million in revenue out of a building. Is it in a building that can support doing $4 million or $5 million? Or are they busting at the seams and there's going to have to be some kind of move to accommodate that? So all of these background elements are part of calculating where the business is and what influences the multiplier.
Thanks. That was a good summary. Like contracts were appropriate. I just want to talk about a situation we had. A seller of a commercial cleaning company came to us. We gave our opinion of value. There were no contracts with any of the clients. They didn't like our valuation. We said, well, the way to improve the value is to get contracts. The seller told us, my clients won't do it. We said, try anyway. He got 100% of his customers' clients under contract. We got double for the business what we thought it would get in the beginning because we took the risk factor out of it for the buyer. So small business multipliers, SDE multipliers, the range is typically 1 to 4. Smaller business, smaller multiple, larger business, larger multiple, because there's a larger pot of money. Typically, larger businesses have better systems in place. Of all the businesses, and this includes really small ones, 2.2 has been kind of the national average. We were inching up pre-COVID to over 3, and for certain businesses, and it tended to be larger businesses, but the smaller ones were still in the low 2s. And these rules change for larger businesses or if strategic buyers are interested, because strategic buyers can sometimes do different things with the business than an individual can. We have to base our valuation on how an individual paying for the business out of the earnings of it is going to see it. So just going to give you a,
Suzanne,
yes.
I was just going to add on that. When you were talking about good, strong businesses, larger businesses, we're talking about those with SDEs of 500,000 or more, often getting up towards the 3 multiple even a little bit above that. That 2.2 national average is amazingly consistent over a long period of time. That is something that goes back years and years, and it only moves a bit at the margin. It really is not something that's going to move day to day, week to week, even year to year very significantly.
Right. So just to show you a numerical example of this, if we have a business that we've calculated the SDE earnings are 400,000 on, and we've done an analysis of the risk factors of the business, and we determined it was 2.5, and that was just pulled out of the air for this example to come to a nice $1 million value. Smaller businesses tend to exclude the working capital. Businesses that are selling via the EBITDA multiple level tend to include the working capital. So there's a difference right there. But that's a really quick preview of business valuation to set the stage from where we're going. So along comes COVID. So we sat down and we talked a lot about it, and we decided businesses fall into 3 categories. Some businesses were not affected by COVID at all, and some are even doing better. Liquor stores, for example. We're all sitting at home, we're all drinking more, we're not going to bars, we're not going to restaurants. Those businesses, bike stores as well, we all decided we needed to get into biking. What they have to consider is they got a boost. A bonus, because remember, it's what's it going to be like in the future. Eventually, as bars and restaurants get busier and we do go out more, liquor store sales are probably going to return to a more normal level. And so we're going to actually have to downgrade their financials a little bit. Anyway, those are the businesses that partially shut down. Buyers are going to value these cautiously, and it's going to be how quickly can these rebound. And we're going to go through these one by one, these categories. And there are the businesses that were totally shut down, and some are still not open. Some can and will reopen. Again, heightened level of caution with the buyers. And unfortunately, there will be some that do not survive. So let's go through.
By the way, in terms of businesses that have been affected by COVID, there are a couple of reasons they could be affected, and they could be valued or looked at differently. One can be that the demand for their services has dropped. They're just not necessary anymore. Another one can be that they were forced to close down by regulation. And in other cases, it might be they've been unable to maintain the employee base to keep the businesses going. So understanding why they were impacted can be as important as just the fact that they were.
True. So the businesses not affected by COVID are going to be very desirable. Valuations will hold and maybe improve. We decided we start with 2019 valuation as a starting place. In the beginning of this crisis, we didn't know what was going to be the future of SBA, Small Business Administration lending, which is the primary source of financing for small businesses. And the PPP money was kind of intermixed with the SBA money. And fortunately, we've learned that there is money available. The second wave of financing didn't get all used, so there is money. For these businesses, it'll be like nothing happened, and the buyers will be all over these businesses. Partially shut down businesses, the valuation will depend upon how fast the business can rebound and can it operate at full capacity. We're seeing all these businesses that are, 25 or 50% capacity, and hopefully that's a short-term thing because it's just not economically viable to operate at a minimum capacity for a lot of businesses. Financing is going to be on a case-by-case basis, subject to a lot of assumptions and scrutiny. If you want to sell a business like this, you're going to have month-by-month financials and the month for the prior years to compare it to. And you're going to have to get pro forma projections for the future. The SBA is going to allow this, and this is something that's new to us. And I was talking with Susie and Jamie, we were talking with them before the show about it, and the Boulder SBDC has some great resources on people that can help you with this, so contact them. Now, on these deals, there's going to probably need to be some deal structure creativity, so we're going to get into that subject shortly.
Suzanne, on the pro forma projections, just to add a little bit to that, what we're seeing from the SBA lenders is absolutely they're expecting a pro forma, but they're also expecting the information behind the pro forma that says this is the rationale for why these pro forma numbers will in fact play out as we're presenting them here. They really want to know the why on the pro forma, not just see a chart with growth coming back.
Yeah, you cannot just pull a number out of the air. You've got to be able to explain why this number is realistic.
Yes.
Okay. And then there are the businesses that were totally shut, but they can, and some have reopened. So if they can reopen, to what extent? A lot of businesses, really can't survive in the long run on social distancing, reduced income. Don and I have been working on a project. It's a service-based personal service business. And unfortunately, based upon the regulations, it's not possible for them to get more than about a third of the income that they had previously. Their landlord has been great in working with them, and so the rent is down. We haven't seen the P&Ls yet, what it looks like, but we've been trying to work through a strategy with them. So can these businesses adapt? So there's going to be one or two choices. The price will, if somebody buys it now, will either be a distressed price, they'll take the risk. It's all about risk, and pay some lower value. But what we are trying to do is get the seller back to what the business would have been worth pre-COVID if the business can rebound. And it'll take time. And so for the seller, it's a question of, is the time or the money more important to you, and can your business survive? And do you have the working capital to make it, to allow it to survive through this?
By the way, that not only is it can reopen, but we're seeing now some businesses that have reopened. They've begun to reopen over the past month or so. In Colorado, here is regulations allow them to do that. And they're starting to put a toe in the water and see what that demand looks like and what those cash flows might be.
Yeah, and Don, you already alluded to it, but crazy enough, this particular business we're talking about is having trouble getting their service providers to return. The life on unemployment is pretty cushy, apparently.
Yeah, there's really two things. One is unemployment is actually pretty rewarding. At least it will be through July, when the $600 a week federal supplement plays out, and they're only on state. And secondly, in some of these businesses, the employees really are considering the risk of being in that role day to day. And so where they have those close interactions.
Okay. Then there are the businesses that are totally shut and probably not going to reopen. So what this means is a liquidation of the tangible and maybe some of the intangible assets. So there are people out there you can sell your furniture and fixtures, equipment, inventory through, but sometimes some intangible assets might have value. Like, let's say you've got a customer base or contracts. There might be somebody else in your industry that's willing to pay you and take those over. A lot of these businesses that are not going to reopen, it's what's the status of the lease? This is a big deal because in most small businesses, the person that owns the business is personally guaranteed on the lease. And that doesn't go away just because of COVID. So this is where you need to get your attorney involved. Can the owner get out of it, or can they get somebody to take it over? And then bankruptcy is going to be a maybe one of the decisions that these business owners need to look at, and they need to get the advice of a good bankruptcy attorney. Okay, so where do we start if someone comes to us and wants to sell? So back to the theory, we value the business pre-COVID and say, okay, let's see if we can get you there. And that's if the seller can hang in through the sales process. So in the price is equal to earnings times multiple formula, we're holding that the traditional multiple should prevail. It's the earnings that might not hold. And the question is, can the business rebound to justify this pre-COVID value? And can we structure a deal to reflect this risk? So maybe the business is only at 25% now, but we can get it to 50, then 75, then 100, and the business will rebound. That value in a year will be there. So the seller shouldn't lose it, but they have to run with the risk. So when we finance a business, this is a three-legged stool. There's cash. Historically, most of our deals involve bank financing, and then a lot of our deals involve some seller financing on top of this. And so the question is, how much and how do these three financing methods play together? So the status of the banks. The SBA 7A lending program, which is how you finance small business sales, has been very valuable to the economy, and fortunately the government recognized this. This number is a couple weeks old, but after the second round of PPP, there was still 100 billion left in the coffers, so thank goodness there's money. As we discussed, lenders are working off of projections now for the future. Definitely higher levels of scrutiny on the business and on the buyers. If you've eaten in an Italian restaurant, it doesn't mean you can buy an Italian restaurant. You have to have relevant and transferable experience. It doesn't mean you have to have done exactly that thing, but if the business has 20 employees, they're looking to see that you can manage 20 employees. You've done that before. And cash reserves. They are wanting to make sure that the buyer has cash reserves to ride through the waves if there's another round of COVID. They are definitely looking for more cash in the buyer's bank account than they used to. Don, anything to add to that?
Well, I think we talked to, just so folks know, we're having to talk to SBA lenders every day. I think the information that Suzanne has presented here on the screen is something that's universally out there. Different SBA lenders, though, are having different adjustments that they make. Some might say, given the following uncertainty, we're not going to be in the restaurant business, or we're not going to be in the construction business, or we're not going to take loans over a certain size, or we're pulling back in general. So it's really important, if you are in fact looking to acquire a business, that you talk to a number of lenders, because they are all going to be different even though all of these general terms are applying. And you may just find that there are lenders with much healthier appetites for what you're bringing to table and the type of business than others.
Yeah. At the beginning of COVID, when the PPP came out, all the lenders just shut down SBA lending and went into the PPP business. And then some have come back and some haven't. Okay. So there are some really exciting things going on in lending, actually. Many of you may have heard about the 6-month payment holiday. So if you can get a loan closed and funded by September 25th, it said September 27th and everything, but it's a weekend, so it's September 25th, you can get a 6-month payment holiday. Nope, it's like getting 5% off of your loan if it's a 10-year amortization. No payments. So you just got a screaming deal. They're talking about getting the bank guarantees from 75% to 90%. That's not done yet. But financing is never going to be cheaper. Don, didn't you look at a deal that you got 3.65% 10-year fixed?
10-year fixed. Amazing.
Yeah.
It's I was watching something earlier today. The person was quoted, I don't know if this is exactly true, but said the cheapest money in 5,000 years right now.
Well, in my career, I've never seen numbers like this. It's always balanced. Buyers are going to be subject to a lot more stringent qualification. It's going to be harder to get these loans, and a lot of businesses won't qualify. But if you own a business or want to sell one or want to buy one that will qualify for SBA lending, boy, it's a great time.
And just really quickly on the process side of that, just to say, there's 2 qualifications, obviously. There is the business, and the lenders have to look at the business and say, yes, this is a business worth loaning on, regardless of the buyer and how much they'd be willing to loan. And that's super important to get that information up front, because that's going to drive the ability to put a deal together. On the other side, and we've talked about it, is the qualifications of the buyer. Do they have the appropriate down payment? Do they have the liquidity to support the business in case there's a long term? So 2 pieces of qualifying that have to happen for a SBA loan to happen.
Okay, good. So, however, there's always a however. So fewer cash sales are likely, and fewer businesses will qualify for bank financing. People that have money are holding on to it and trying to leverage it. Our kind of pre-COVID SBA formula, the businesses we liked, was where the buyer would come in with about 20% of the business price. Actually, the transaction price, the business price plus the bank would lend on working capital. So that would fit into that equation. The lender liked to come in at about 70%, so we're up to 90, and they liked the seller to carry 10%. And that was because they wanted to ensure that the seller stayed through the transition, that the seller had a little skin in the game and cared about whether the buyer succeeded and would help the buyer out if there were any problems. So that was kind of our sweetheart deal. As the risk goes up, the lender is naturally going to try to transfer some of that to the seller. So we were lucky sometimes and could get it where they would not require a seller note. Those were in deals where the buyer had a great background and maybe even had a business they were adding it to, and so it looked pretty strong. But we think there's going to be less of that. We think sellers are going to become the lenders on businesses, on a lot of businesses. And there's a number of mechanisms that will come into play on that. There will be promissory notes, something called earnouts, something called adjustable seller notes, There's going to be assumption of the receivables and payables and debt and lease assumption. Going to go through each of these as a financing mechanism. So what is a promissory note? It is a loan from the seller to the buyer of a business. The amount, terms, conditions, collateral, and recourse are all defined in the note and the asset purchase agreement. Most of the time, the buyer and the partner or spouse of the buyer has to guarantee this note in small business sales, and outside collateral may come into play. If the business has a lot of tangible assets that can be liquidated, that's collateral for the seller. But if there's none or very little, the seller may ask the buyer to put up their home or a second home or something of value. And the SBA always asks buyers to put up their home if they have enough equity in it and there's not enough collateral in the deal, which there almost never is. Don, anything to add to that, or?
No, I think that's right in terms of promissory notes.
So the buyer would put down some down payment and then the seller would carry some of the difference or all of the difference. So something called an earnout is popular. This is where all or part of the business price is determined by the future sales, gross profit, or net income of the business into the future. And so this is for a business that we don't know if it's going to come back 100%. So what the buyer says is, okay, you were doing $1 million in sales pre-COVID. If the business only comes up to 800,000, there isn't as much value there to me. So I will pay you some percent of that 800,000. If the next year it goes back to 900,000, okay, I'll pay a little more. If it goes to $1 million the next year, okay, we're back on par. And if it goes to 1.1 million, maybe the seller gets more. So remember, look that it says on future sales, gross profit, or net income. We try to always do it on sales first. Gross margin, if that's variable, and net income is really hard to do it on because buyers have a lot of leverage to manage the income statements and make net income not look very good.
Suzanne, the real world example for that is the movie industry, which has proven that they've never made money on any movie ever made, even though they've been around for 100 years. So the books can be managed to have that outcome, no question.
So this earnout can have a maximum price. You can say, okay, we thought the business was worth $1 million before. So as soon as we hit that $1 million cap, we're done. Or it can have no limits on it. The seller might earn more, be rewarded for taking the risk. As a note, the SBA does not allow earnouts. So if you are getting an SBA loan, this option is not available to you.
Suzanne,
however,
oh, go ahead.
Nope, go ahead.
I was just going to say, this is always a kind of a contentious, to use a term, discussion between buyer and seller, because there's one concern that the business revenues are down despite the business being well managed by the new buyer and everything being done right. But it is external forces that are keeping the business from reaching its potential. Seller is always worried that it's going to be the buyer's errors that are going to keep the business from doing well. And a lot of times resolving that is a part of structuring an earnout. And it's impossible to really know or forecast up front what's going to be the cause of the numbers being lower or higher.
That is a really great point, Don. Thanks for bringing that up. Yeah. So there's always a back door. So this back door is something called adjustable seller notes. And they're emerging. So there's 4 terms that are being bantered around right now: forgivable promissory note, earn down, clawback note, or reduction note. And this can be all or part of the price, but the buyer only pays on the note depending on future business revenues or other metrics. What happens here is the note will specify if in year 1 the business sales don't hit $1 million, there will be a reduction of this amount of money. What happens with these, the SBA will accept these, and most of the lenders are accepting them, not all, so you need to talk to your lender, but the price cannot go up. So if the price is $1 million, with the earnout, the seller could have gotten more if the business did well and rode on the risk, with the buyer. With the adjustable seller note, the price can only be achieved or go down. That's the difference.
Right. And the reason the SBA is comfortable with these is ultimately, if the price goes down, it makes it easier for the purchaser to pay back the SBA note. So it's a win for the SBA. And so they're comfortable with it because they've evaluated getting their own money back based on higher levels of revenue, and authorized the deal at that level. So.
And the SBA won't allow the earnout because the buyer's putting in a certain amount of money and they want a certain ratio of equity on the buy side there. And with the earnout, that messes it up. But with the adjustable seller note, they're in control of that. So this is something we haven't done as much of in the past: accounts receivable and accounts payable assumptions, wherein the buyer takes possession of the AR as a financing mechanism and the AP. The price would be increased because of that. So if you're doing $1 million deal and the AR AP difference is 200,000, all of a sudden the price is 1.2 million. The buyer will assume the liability of the AP with or without creditor approval. So if a business has 200 creditors, it's highly unlikely you're going to go to all 200 of them and get the approval of each of them. So the seller is taking some risk here. The seller is still ultimately liable on the AP. Involve an attorney if you do this. But we think, as desperate times call for desperate measures, and we're going to see a lot more of this. We also think we're going to see a lot more assumption of debt or leases. That would be equipment leases. So this again can be with or without lender approval, and you definitely need your attorney here. Some of the notes, etc., definitely say the seller's in default if they, let the buyer take it over. So you've got to weigh that risk. But last year, about this time, I had a seller who absolutely wanted out of his business, and he wanted his manager to buy the business. And the business was worth about $300,000. The buyer had $10,000. So that didn't fit any of our ratios. And if the buyer gave the seller $10,000, he had absolutely no money for working capital. So this is what we did. We figured out that the accounts receivable payable difference was about $60,000. So the price went from $300 to $360. This business had 3 very large pieces of equipment that were under lease, and those were worth about $75,000. Well, the business had been paying the lease expenses on these, so the buyer took over these leases without the leasing company's permission, because the buyer wouldn't have qualified. He didn't have enough money. So that basically added $75,000 to the quote unquote down payment, because normally the seller would have paid those off. Anyway, by the time we did all of that, we also extended the term of the payment, the promissory note. So more years, and we figured out what monthly payment the buyer could afford and match the note to that. And so far, it's been working out beautifully. So desperate times call for desperate measures, and all's working. Okay, next topic. Are there buyers out there? Don, you beat me to my thunder. I just said yes, but you said yes, but.
I said yes.
So we've been getting large number of buyer inquiries. That's been great. Every month or every week we track it, and it's been very strong. So people want businesses. So let's look at what that might mean. If you're a buyer, this is a time of opportunity. Top tier businesses are still gonna, sell for good prices, but there's gonna be screaming deals on the other end. People who can't hang in there, and the buyers are out there, including the bottom feeders.
And Suzanne, I think it's important to say that when you say a business can't hang in there, it's not always the business itself that can't hang in there. It's the capitalization of the buyer. And so a new owner with a different capitalization structure can, in fact, weather the period of time until things get stronger. It's just that the current owner cannot. And that causes them to exit quickly.
Yes. So the deal structure will reflect the economic risk or the seller's desperation. That's where the screaming deals come, and that's where the bottom feeders show up. So what are the buyer concerns? Buyers are scared, and they're trying to structure their deal around the perceived risk. So back when the planes hit the buildings on September 11th, I was selling a quick lube, and I had a first-time scared buyer that was under contract, and he called me up and he told me, "You are trying to sell me an obsolete technology." And I said, "Do you mean the internal combustion engine?" And the guy said, "Yes." We didn't get to the closing table with that buyer. That business is still around. It's done well. Most of us, or a lot of us, are still driving cars that require gasoline and oil changes. Unemployment is high and will be high in the future, and people are going to need to buy jobs. We had a really nice carpet cleaning business for sale last year. It was making good money, but it was just plain and simple unsexy. Well, it's also COVID proof, and now that business is a lot sexier. So for existing businesses, this is a great chance to either buy out a competitor or buy a complementary business that is going to augment your current operation. Now, if you're selling the business, please note that these acquirers are only going to place value on what they can't replicate on their own. So if you're a service business, project-based, no, real repeat in your sales to the customer base, those aren't going to be valuable. But a service business that has repeat sales to the same customer base might, if it's a build it or buy it always. And note on the buyer end, a lot of buyers are going to have less cash. They might have lost money in the stock market or whatever, or they just plain and simple won't be willing to spend as much cash. They're going to hoard cash. So the seller takeaway here is you need to understand your value proposition in order to effectively sell or exit your business at this unprecedented time. Get professional advice on this. We, of course, through our relationship with the Boulder SBDC, are always willing to do a consult with you, talk to you about it, and help you find your way. So the sun will rise again. We have been through this before. We've been through the dot bomb. We've been through September 11th. We've been through the recession. Locally, we've been through the floods. We'll find our way to a new normal. The laws of physics and business valuation will prevail. So please call us to talk about your unique situation if you wish. And we're going to turn it over, I think, to a question and answer session.
Great. Thank you both so much. I think this is really great information as people are, thinking through their futures and, what they want to do with their businesses. So I do want to thank you both very much. And I know you've been such a big support of the Boulder SBDC, and we've valued our partnership with you for a very long time. We were just talking about you presenting since the late 90s. So that's a crazy amount of time and very appreciated. So if anyone has questions, please do put that in the chat bar right now, and we'll get to as many as we can. We have about 10 minutes here left over for questions. So we have a couple here. Let's see. One, I guess, would be related to the time frame that you usually see. So, when you start the deal, what's the fastest time you've seen it close versus, how long can that be as people are looking to get money as quickly as possible for some of these businesses that might need to sell? I guess you can give any insight into how long that typically takes.
Suzanne, I can run with that one. If that works.
Okay, great.
I was just going to say, so typically what I would tell any seller coming in is don't expect to sell your business in less than 4 months from the time you list it. Really quickly break that down into 1 month to really get ready to go to market, 1 month to be out there offering the business for sale and attracting buyers, and 2 months to put any deal together, including the financing. So that becomes the absolute minimum. Then I'd follow that up with 6 to 9 months is a much more common time frame from the time you decide you're listing, you're selling, until you've actually closed. But it can go to a year. The question around COVID is, I don't know if the time frame will be longer. There are buyers out there, but the mechanics of a deal are still the same. So it shouldn't really take longer in the midst of the COVID environment, but we might be working through different types of buyers with different types of deal structures, might take a little more negotiation, have to go to a few more lenders, things like that to get the deals put together. Suzanne, any thoughts?
Yeah, I think that's true. However, I think there's the desperation situation and the, desperate times call for desperate measures. So I once had a service-related business for sale, and the seller died unexpectedly. And in about a week, the competitors of the business were trying to cannibalize his accounts. And so we went to a competitor and we offered them a deal, and believe it or not, I closed the deal in 29 hours. And the seller's partner spouse did not get a lot of money up front. The price was totally based on the transferability of the accounts. So in a month, if the new buyer had been able to retain the accounts, they got paid on them. And fortunately, we got 100% of our asking price on it. So I think we're going to see crazy stuff like that. And the seller was almost totally at risk in this case. But if somebody can't hang in there and we can create an opportunity for somebody, the seller's going to have to take risk, but ride with it. I did want to say something about promissory notes. All sellers like, no, I don't want to do this. So just last week, we were working with a business that we sold 2 years ago, and unfortunately, the seller didn't have good books and records, and it required that the seller carry most of the price. So what happened here, it was actually $1 million note at 7% interest. So for the first year, it started at $70,000 a year of interest was coming to the seller. So for 2 years, they got between $50,000 and $70,000 of interest. And boy, I just talked to them. They said, oh my God, what a vacation budget that gave us. And now this buyer with this great new SBA program is able to refinance. He's getting the 6-month payment holiday. He's getting a screaming interest rate somewhere around 4%. And everybody is so happy. So it's not all bad, depending on the business, the sustainability of the business, and the buyer. Any more questions, Jamie?
Yeah, so that leads a little bit into this. So as far as getting a loan, do you need to be able to demonstrate the COVID impact in order to get that loan?
Yes. So that's where the projections come into play, and these need to be well thought out, well documented projections, not just, pulling a number out of the air. Of course, the SBA is looking at the COVID impact.
Great, thank you.
Did I answer your question?
So there are other people asking about the costs associated, with getting the valuation, getting their business sold. So one person is asking, would we go to the SBDC first if they're interested in buying or selling? So like both of you said, you do graciously offer some assistance to meet with people. So that would be my answer there, that we can at least set you up initially with you guys. So hopefully that helps. And we really do thank you for offering that.
Yeah,
Someone.
Normally we'll do complimentary valuation if the seller is serious about working with us. If the brother-in-law wants to buy the business, we're going to charge for a valuation. We'll talk to him for an hour about what constitutes value, but we're not going to go through the whole valuation without compensation. But if we believe they're sincere about selling their business through us, we'll help them with a price.
Okay. Thank you. This person is asking, where do sellers list their businesses for sale?
Every business is unique and it gets a unique marketing strategy. We, of course, have been around selling businesses in this area for a long time, so we've got a really extensive buyer database and our own website that people look to, but there are business listing websites, and then a marketing campaign may involve going to strategic acquirers, doing mailings, advertising in industry publications or e-newsletters. It's unique to every business. That's kind of what we do.
I would add on to that, and Suzanne, I'll just kind of say the name of one common one people can go look at. There is a website called BizBuySell, bizbuysell.com. And it's a listing, and anybody can go out there and put a business up. And one of the strengths is that lots and lots of people go there. One of the weaknesses is there are a lot of sellers who are inexperienced, and a lot of information is not necessarily reliable if it hasn't been put together properly. And so I encourage people to go out and look at it, get a sense for what's out there, how a business is presented, but I would not use other businesses for sale on BizBuySell necessarily as a guide for establishing value, because a lot of sellers put what they want to get for their business as the price and not what their business is worth.
Unfortunately, only 20% of the businesses that are listed on BizBuySell end up selling. Our ratio is much better than that, of course, but and depending what size of business you're selling, larger businesses, there are different listing websites than smaller, businesses. So that's kind of what we figure out in our offering to our sellers. But a seller can go on their own and pay to put an ad up there and may have luck.
Great, thank you. So unfortunately, we are out of time right now, but I really appreciate you guys answering all the questions. There are a few more that we didn't get to, but we will, I said you guys are a resource, so we're happy to get people connected. If you didn't get your answer or your question answered today, I want to thank you both for being on this. Thank everyone for being here today. So we will send a copy of this presentation out in an email tomorrow. I do also have it listed as a handout on the side panel if you want to download it, but that will go out in the email tomorrow, like I mentioned. Let's see, I know there are people signing in from, Don, go ahead.
I was just going to say, if you have a way to get us the unanswered questions, I'd be happy to provide some written answers, shoot them back to you. And when you distribute the slide information, we can put answers to those questions out for people.
Okay, perfect. Thank you so much.
Yes.
Okay, well, I want to thank you all again. We do offer consulting, like I said, through the SBDC. There are 15 centers around the state. So if you go to Colorado, sbdc.org, you can find your local center. But we will be sending out that email tomorrow. Susie, did you have any other closing things you wanted to say?
No, thank you both so much. That was amazing. And I was trying to come up with questions in my head, and you kept answering them each time. I'm getting texts from people saying this is great. So we just really, really appreciate everything that you do. And this was awesome. So.
And thank you very much to the attendees. Glad to have you here.
Thanks, Susie, Jamie,
Thank you.
Rachel, and Boulder SBDC. And Don.
Thank you.
Thank you, guys.
So much.
Thanks, everybody.
Take care.
Okay.